Welcome back to Raising Real Estate Standards. Today we're excited to bring somebody we've known for quite a while. Brad Thomas is with Fairway Mortgage, has been a friend, colleague, a referral partner, all the in between, and is a person who has a vast knowledge of the mortgage industry. Has just asked this question just a second ago. 25 years of experience in our wild world of real estate, and excited because, you know, when we're sitting around chit-chatting, you know, sometimes the conversation is on mortgages, but most of the times it's on college football.
College football, a lot of college football.
Absolutely.
Yes.
It's around just normal. I mean, it just we have a great rapport. It's good to have those people that not only you know, like, and trust, but enjoy having outside professional conversations with. And so excited to have Brad with us today. Welcome.
Glad to be here, man. Thanks for having me.
Absolutely. So today we're going to kind of walk through and have some conversations. A lot of times when we're talking mortgages, it's time specific, and it's about what's going on today in the market and what's affecting our profession right now. And it changes all the time. And but a lot of these podcasts that we do end up getting consumed and listened to months, even a year down the road. So there, you know, not everything that we're talking about today is going to be specific to today's market. It can be translated in a lot of different ways in a lot of different markets. But what's going on right now in our market is a little wonky. We are in the midst of coming out of a high inflation era, and we are coming into the last 13 days to kind of paint this picture, last 12 or 13 days of a contentious presidential election.
Can't wait till it's over.
No doubt. And so when you're listening to this, you might already know who the president is. Thank God we...
Or not. If you remember 2020, it took, what, 3 months before they actually had a decision?
Oh, shit. Let's not talk about that. No. So, I mean, you know, as things go, there's, you know, I'm just kind of painting this picture as you're listening to this, because it's the stuff that we're talking about is hyper specific to now, but is also just issues that we deal with all the time. So do me a favor, just paint the picture of where we are sitting right now in the mortgage industry world. Rates, not necessarily getting specific with the actual number, but just the environment of what we're in.
Man, the interest rates have been the hot button, the hot topic for, what, 3 years now?
Yep.
It's really interesting because the Federal Reserve has been messaging that it's all about inflation. They've been increasing the rates to begin with to combat the huge increase in inflation after COVID, and they have messaged that they'll be cutting the rate once inflation is under control. Their benchmark is 2% inflation. And we're down to about 2.2 right now. So we're really close to their benchmark.
Yep.
And back in September, it was speculated that they were going to cut the interest rate, the federal funds rate. They did. It was cut by 0.5%, which typically the Fed only adjusts in 0.25%. So the cut was bigger than expected. And the market didn't really react a whole lot to the larger cut, which I thought was really interesting. A lot of people think that the interest rate is tied directly to the federal funds rate, which is not true at all. The federal funds rate is an overnight rate at which banks borrow and trade money between each other. They do obviously have an impact on what interest rates will be and what borrowing costs are, but it's not like a one-for-one relationship. And so back in, say, July of this year, the rates were, over 7%, 7.5%, 7.25%, somewhere in that range. And the rates started to come down because the Fed started messaging that inflation was under control. The economy started cooling off. We think that it's time to change the monetary policy. So to the market, that meant, hey, they're going to cut the interest rate. Mm-hmm. And the amount of how much they were going to cut the interest rate was the big question. Is it going to be 1/4? Is it going to be 0.5%? We just don't know. And so as we got into August and early September, the rates just started coming down. It was a nice time. It felt really good. It was very motivating. Borrowers were excited about it. Realtors are excited about it. Everybody was excited about it. And so we ended up seeing interest rates come from about 7.25, 7.5 down to the low sixes, 6.125, 6.25. Then the 0.5% cut came. We thought we'd see a little bit more of a dip. We saw nothing.
It literally was as flat as it could possibly be, and you know, some of us were under the mindset. You know, some people follow financial stuff really tightly, and you know, there was this like, okay, there's this J sort of situation where it's going to flatten out, and the term baked in had been, oh my God, if I hear that term ever again, it's just like it's baked in. So the rate that the mortgage rate was already including that 0.5% Fed funds. That's what they kept saying.
The speculation
was
of
that,
the cut.
and it was already included in that. And it's like, okay, well, if that's the case, then it'll stay flat, and then probably tick down a little bit as the projections that they would still be reducing rates for the next 15 months is still the what they're saying is the potential of reducing rates then through the end of this year and then into 2025.
Correct. Yeah, and so it was really interesting because the Fed messaging after they cut the rate, they deal in 0.5% increments. So the federal funds rate is now at 4.75 to 5.25. Mm-hmm. And their message that literally the day that they cut the rate was that they saw by the end of the year we'd be down to 4.35%, which is another quarter to a half cut moving forward before the end of the year.
Right.
All of a sudden, that changed. That changed overnight. October 4th,
Yep.
The jobs report. It was anticipated that 130,000 new jobs would be created, and 254,000 jobs were created, according to the Department of Labor.
So let's stop there for a second. You and I have had this conversation a number of times. So the jobs number were a lot higher, which means that according to the numbers, and for those that aren't watching, we're doing air quotes, the accurate numbers, that the economy was going better than what they had presumed.
Correct.
So they're concerned that could tip inflation, inflationary pieces, and not necessarily the need to cool down the economy.
Correct.
But what happened not 2 weeks prior to I think it was 2 weeks, maybe it was a little bit more.
It was August. I just looked it up
Was
this
it
morning.
August?
Yeah.
Okay. So it felt like 2 weeks.
It did.
Jesus Christ.
It did.
We're getting old. But anyway, time goes by really fast. So in August, they're made an adjustment to a year's worth of job numbers.
Overstated by 818,000.
Right. So the numbers that we're using, that the economic world is using to determine what the 10-year bond rate is, which ultimately determines what the mortgage rates are based upon a lot of these economic indicators. And the jobs report of 200 and what was it?
245. 254.
254,000, which was greatly more than what they thought. These are the same fools that put together the job report that had to be adjusted downward 800 and some thousand jobs.
That's right. So that's what is really interesting to me is because when this jobs report came out on Friday, October the 4th, interest rates went from literally 6.25 to 6.5, 6.625, like literally in the blink of an eye.
Right.
It took absolutely no time. It caught everybody off guard. And what I don't understand, what I'm questioning is why do we believe this number now?
Right.
When just not 2 months ago, they came out and said they were wrong and they way overstated what the jobs numbers were.
Yeah.
So why are we putting so much weight into this jobs number all of a sudden?
No doubt. And so, and I said this just a second. I'm going to backtrack just a second. And I said these fools came out and said, "Well, I'm going to pull that name or that attachment of fools." I think there's just there's issues in the systems in which the numbers are aggregated.
Absolutely.
And it just doesn't make sense.
Absolutely.
There's a lot of smart people that are looking at this and are making determinations, but for some reason, a huge discrepancy over a long period of time brings in speculation of why is it bad? Why are we getting bad information?
These numbers are always adjusted.
Yeah.
Always adjusted. Like one thing that really stood out to me when the big adjustment came back in August was that a large number of the jobs created were government jobs. A large number of the jobs created were not new jobs, but they were people that already had a full-time job taking a second job, which to me is a sign that
Inflation may
people are struggling. They need more money. I got to get a second job.
Right.
And so they always adjust these numbers. And so the numbers that came out earlier this month probably will be adjusted. I just don't understand why the market put so much weight into those.
Sure.
And why the interest rates spiked so quickly. 0.25% increase in mortgage rates doesn't happen overnight typically.
No.
Usually it takes a good 30 days for rates to adjust by 0.25%. So when we see an adjustment like that overnight, it's huge.
Right.
It's
Absolutely.
huge.
So let's back up for a second. So that's the current market and what we're living in right now. And for you and I, who this is our profession, we're doing this every single day. We're not just doing it when rates are great and stopping when rates are bad. This is what we do day in and day out. And so there becomes strategies. There becomes, okay, what are we going to do? What options are out there to be able to help folks in that are in situations that they need to buy or sell? Because majority of our listeners are real estate professionals, right? And mortgage lenders, because they're interrelated. We basically do the same job. We're just selling a different product.
That's
right. Majority of the home purchases in our market right now are necessity based. And that's typically the case.
True.
It's life. Life happens. I mean, people get married, they need to buy a house. People have kids, they need to get a bigger house. Kids move off to college, thank the Lord. They get a smaller house.
That's right.
The kids then graduate from college, and we're ready to settle down into our senior years and do different things. We make another move. So that it's life happenings that typically necessitates the purchase or the sale of a home. So over the last 3 to 5 years, there is a huge number of people that have been sitting on the sidelines where life has still happened, yet they haven't made the typical move that they would because of the rate in which they bought that house, that 2.5% house. They've just been sitting on the sidelines. And so there are a number of those folks that will enter the marketplace just out of necessity, but there are some that will stay on the sidelines. What are we doing? What are we trying to for us that it's our business to help these folks get to that next place? What are some strategies that you are implementing? You're having conversations with people to help people overcome that fearfulness. I don't want to get rid of this rate and go on to buy something, right now.
Well, that's a hard challenge to overcome, right? Because if you owned a home prior to COVID, let's say that you had a $200,000 mortgage. Let's say that you refinanced that mortgage, or if you bought during COVID, you got a rate that's in the 3% range, right? Mm-hmm. And prices have spiked so high that now, if I have a family that's outgrowing this house, maybe I can sell this house for $400,000, and I only owe $200,000, so I make a gross profit of $200,000 on it, which I can use to put down on my next home. But now to step up in size, now instead of spending $400,000, I got to spend $600,000 or $700,000. Which means if I put $200,000 down on that $700,000 house, now instead of a $200,000 mortgage, I have a $500,000 mortgage that's at double the interest rate. Yep. So it's understandable why a lot of people are in a holding pattern right now as far as selling. But as far as like the buyers are concerned, one thing that I'm trying to convey to them is that, especially in this immediate time that we're in right now, it's kind of like a little mini buyer's market. Yep. You're seeing properties sit for a good bit longer. You're seeing buyers that are getting properties under contract at or below list price, or they're getting some seller concessions, things that we haven't seen a whole lot of over the last couple of years. And one thing that we know is that the supply of housing is low. And it's not low at the moment because the demand is also low. But as those interest rates come down, that demand is going to increase and the supply isn't going to be able to increase at the same pace. And so we're going to start to see, prices go up again. Not as dramatically as we did during COVID, but what I try to convey to buyers is that, hey, you may have a home that you can buy for $300,000 now. And if you wait until rates come down, there's going to be a lot more competition. You may have multiple offers and you may have to pay $320 or $330 for it at that point in time. So if you buy now, you're going to build equity once these prices start going back up when the rates come down.
No, I agree, and I think there's part of this equation that a lot of people don't think about or haven't thought about because it's. Let's just be real honest. Buying a real estate property, a home, can seem very simple, but it is not.
Not at all.
It is super complex. There's a lot of moving parts, and I'm going to add something into this equation because those that are sitting on the sidelines or that are buyers that are waffling back and forth about whether right now is the time. I can wait and get that lower interest rate, maybe, but I would argue that in times right now, like you said, we're a mini buyer's market. It just feels that way because we were in such a deep seller's market previously that it feels, but it's still not there yet. But what buyers have the opportunity to do right now is they've got more choices. Not a lot of choices.
Not a lot, but more.
They've got more choices. We've got.
They've also got more time to make that decision.
100%, and ultimately, sellers that are actively in the market that need to sell right now are at a point where they have to do more to their house to get it ready to sell. They have to, you have to be the prize pig at the fair to get your house sold. You can't just throw a really dumpy looking property and expect someone to pay top dollar right now.
That's right.
So the sellers are doing more to their house to get them ready. In and when they do inspections, the ability to go back to that seller to get them to make needed repairs during this process of purchasing is there, which was not there and will not be there once we enter into a fast and frenzy market again. So ultimately, yes, you may be paying a higher interest rate, but you're not sitting there outlaying $40,000 in repairs as soon as you buy this house that the sellers were refusing to do because there was 19 other fools willing to buy the house.
That's right. So one thing that I always try to show buyers is that yes, maybe the interest rate is pushing 7 right now, and here's what your monthly payment is approximately. But we still know that rates will come down in the future. There's all kinds of historical data that show exactly why they will come down. And they're expected to come down to the 5% range. I believe maybe they'll come down to the 4.5% range. So I always try to show them that here's what your payment is now at pushing 7%. But we can refinance this thing probably in 2.5 years' time. At 5%, here's what the payment would look like. And sometimes it's astonishing how much of a difference there is.
I would argue, and again, this is just a gut thing. I would argue for the person that's going to buy a house regardless, if we're waiting, we're going to buy now, but we're going to buy a house, and this is the house that we're going to buy. Cash on cash return, even at a higher interest rate, you're going to make more money buying today than you are going to wait.
Correct. I like silver linings too, right? The good, nice silver lining about buying now and paying a higher interest rate is that means a higher tax deduction.
Yeah.
You're paying more interest per year, which, on a monthly basis doesn't feel great, but it feels great when you get a nice tax return because you have such a nice deduction.
No doubt, but the biggest piece of that puzzle is you're able to ride the wave of appreciation. Houses appreciate typically on a percentage base, right? And if for the move up buyer, if you need to move up, the appreciation rate on a $600,000 house versus a $200,000 house that you currently own, 2% of appreciation on a $200,000 house and 2% of appreciation on a $600,000 house are different numbers.
That's right.
They're different equity numbers, and so again, that's why I say purchasing. It's people. When should I buy? Yesterday. You should always buy real estate yesterday because you will never, that time that you're in the game and you're in that property, you're never going to be able to get that time earning power back. And so it's important. So all right, so we know that it's time to buy. So let's talk about some of the options that people have. Some of the things going on in the marketplace. Some of the things that obviously most of our listeners understand the mortgage market at a high level. We understand conventional. We understand govies, FHAs, VAs, and things of that nature. But talk to us about some things that maybe we don't know about. Some of those. Just products that we're unaware that could help our folks in today's market.
Sure. So we all know that conventional Fannie Mae, Freddie Mac, or FHA are typically going to be most buyers' best options, but not every buyer can fit into the guidelines for those types of loans. Specifically, self-employed folks or 1099 folks that write off a lot of the income that they earn. They just don't claim it on their tax returns. Fannie Mae and Freddie Mac, conventional loans, FHA loans are all what are called qualified mortgages. So they have to meet certain criteria, and someone who doesn't claim much income on their tax return maybe makes a lot of income but writes a lot of it off.
Real estate agents, does that make
Real
sound
estate
familiar?
agents maybe fall into that category. So now there's a lot of new products, what we call non-QM, non-qualified mortgages. They are very similar to, I hazard to use the term subprime, but there's some similar characteristics to some of the old subprime loans, but they are very different. They require a much higher credit score these days. They require much more down payment these days. So we're not going to see what happened back in 2008, 2009 again. Because there's a lot of guardrails put in place.
Yeah.
So some of the popular programs that we're seeing are using one's bank statements to calculate their income. What we do is maybe you have a business and you have a separate bank account for business use only. Well, we can take 12 months or 24 months worth of your bank statements and average out the deposits over that period of time and say that this amount we can use for income for qualifying this loan. In most cases, with the best borrower credit scores, you have to put down at least 10%.
Yep.
As the credit score goes down, the down payment increases.
As naturally it should.
Yes, absolutely, absolutely. And that's one way that we can calculate income with some of these programs. Another way is we can use the 1099 that's reported. We take the 1099 income, we don't look at the tax returns, and we kick off the top 10% and use that as qualifying income. So there are some really cool strategies that are coming out to help people that are 1099 self-employed and don't use or don't claim a lot of that income that they earn on their taxes.
Yeah, cool. So, all right. I told Brad we're not going to get into the nitty gritty of too much technical stuff here because people get lost in that.
It's pretty boring.
It is pretty boring. I mean, let's just be honest. It's not sexy. It's numbers. It's moving numbers around and ultimately just trying to get to be able to buy a house. The big thing is there's a lot of different options out there. There is very few of those vanilla buyers that are W-2'd employee with 800 credit scores.
Very few.
And ready to buy with 20% down and it just fit that mold. Most folks are a little bit different, have some nuances that need to be worked with. And so it's important when you're working with folks, knowing that you've got complex buyers because we live in a complex world these days, especially with the gig economy and a lot of people doing a lot of different things where income streams are coming from various different places. It's important that you have someone who has a good amount of knowledge and has the ability to decipher these complex things and bring it down and be able to help a larger number of people. I see a lot of times when you have new folks into the business, they're just ignorant to a lot of how do I make this work. Whereas the experienced folks that have been doing this a while have seen a lot.
Have seen it,
and they've done a lot. They have skinned their knees, they have bumped their heads, but they know how to navigate to be able to figure out how to make it work in a situation that it should work. Not making it work for situations that should not work, but finding those situations that should work and be able to figure out how to get there. Quick question. Switch gears for a second. We work in the same sandbox, right? We play with the same group of people. How do you see real estate agents and mortgage lenders now working together versus 15 years ago, and what are some ways that real estate agents and mortgage lenders can work together better to make this process as easy and as removal of stress on the consumers as humanly possible?
To me, communication between real estate agent and lender is always key.
Yeah.
If we're on the same page, we can give good advice to the buyer. We can work out solutions. It's always the key to a smooth transaction, is having a good team of people working together. That's one thing that in the past, take the COVID times, for example, when things were just out of control. There were a lot of real estate agents that I closed loans with and just never had the time to talk to them very much.
Right.
And so, I think a good partnership between a realtor and a lender is critical. Obviously, getting someone pre-qualified up front before you show them property, critical,
Yep.
so that you're not looking at property that they can't qualify for or that they can't afford or that they're not comfortable with the payment. And communicating those two things between lender, real estate agent, so that we can give the best advice to the buyer.
All right, so cut through the minutia of communication is absolutely the key. Let's break that down a little bit. What does that look like? I mean, the term's been coined a number of times. Buyers are liars. People that are trying to do something, and it's not necessarily they're lying. They're trying to put their best foot forward. They're trying to show everybody that has, in their determination of whether they're going to get the deal done, information that may not be completely a fully written picture. But what are the those communication lines? I mean, we're getting pre-approved, but what else? What else can we do as agents to be on the lookout for, to try to keen into that could help?
I mean, one thing that I would say is for real estate agents to prepare their buyers with an idea of what type of documentation they're going to need.
That's a great idea.
One thing for me that is a huge help when I'm pre-qualifying someone is looking at their income documents. I've been doing this long enough that, I know, people that know their situation. I know who I'm going to need to review their documents before I'll issue a pre-approval to.
Right.
And so, of course, I ask them for their pay stubs and W-2s and those sort of things up front before I actually issue their pre-approval letter. But if the real estate agent could prepare them that they're going to need that for the pre-approval process, it's super helpful. One thing that we see a lot right now is folks that they may have a full-time job, but they just don't work 40 hours a week for whatever reason.
Yeah.
And so in my world, we call that variable income. I can't calculate your income on a 40-hour week if you're averaging 37 or 38 hours a week. And with the rates being high and the prices being high and the debt ratios being tight, that makes or breaks a lot of situations.
Sure.
So reviewing documentation up front, knowing where the down payment is coming from, discussing where the down payment is coming from. It boils down to, credit, collateral, and where the money's coming from.
Right.
And so if we address those things up front and review those things up front and talk about all those things up front, then the buyer knows what to expect. They have the documentation ready. They've talked it through with the lender. They've talked it through with the real estate agent. Everyone's on the same page. Smooth process.
So my understanding from my gathering of this is, front end stuff is the most important time. It's the critical make or break, and it can make for a easier transaction, smoother transaction, if the borrower is just prepared. All right. So that being said, do you have, and I'm not asking you to deliver it here, but maybe if there is something, so when we meet a client that calls off one of our properties, hey, I want to go see this property. Fantastic. Have you talked to a lender? How are you looking to buy the property? I'm going to be financing it. Okay, fantastic. Have you talked to a lender? No, I haven't. Okay, first thing we need to do is we need to get you in touch with a lender. Here are a couple of people. Here are a couple of names and numbers. That's typically what real estate agents do, mm-hmm. right? And then they hand over or text over a name or two or three of folks that they're working with. At that particular point in time, if they had a templated text message or templated something to hand somebody, hey, here are 3 people to call. By the way, they're going to need this information. Make sure you have it before you pick up the phone and call.
Yeah.
That's going to make life go a lot smoother.
Well, absolutely. And a lot of buyers, not buyers, but a lot of people in general, maybe somebody works a blue collar job and they don't have access to a printer and a scanner readily available. They don't sit in front of their computer like we do all day.
Yep.
I do. And so, asking that person to, hey, print, your last 5 or 6 pay stubs and your last 2 years W-2s and bring them to me, your real estate agent, and I can scan them for you.
Yeah.
So that we're not getting these grainy pictures, these difficult to read
snapshots of a phone that
my
iPhone may or may not include all the pages.
Yeah. My iPhone has a scanner on it. Those they do have a scanner on them. They don't look good quality.
Right.
So yeah, I think that's one thing that realtors could do is kind of prepare them for the things that they're going to need. Hey, bring them to me. I'm happy to scan them for you. I can even send them to you so that you can send them out to your lender or multiple lenders if you're talking to multiple people.
Awesome. I'm gonna put you on the spot, and whether you have one or don't, doesn't matter. We're gonna go get one. I want you to, if our listeners here said, hey, can you give me that list of what you need? Can you put together a little template, a little PDF of this is what you need to get your initial contact with folks that need to talk to a lender. Have them do these things, and if they do that, you're going to solve 80% of the problems.
Main things, simple. Current pay stubs.
Yep.
Last year's final pay stub.
Okay.
W-2s. Income is what we need to verify.
Okay.
I'm going to take your word on, that you have roughly X $1,000 in the bank.
Yep.
Or that you have access, mom or dad or grandma or grandpa is going to give me a gift of, this much for my down payment. I'm not as concerned with reviewing the assets up front as I am with reviewing the income.
The income. Okay.
Because, again, people might have a full-time job. They say they work a full-time job, but that doesn't necessarily mean that they're working a full 40 hours a week.
Yep.
And so I like to get the last pay stub that they received last year, because that's going to break down what their base pay was, what their overtime pay was, if they had any bonus income, rather than just the W-2 is going to give me their total income, but it's not going to break those down individually. Okay. And when the income is variable, it has to be averaged over a 2-year period of time. So bonuses, always averaged. Commission, always averaged. And in a lot of cases, hourly, when it's not consistent, averaged.
So what is hourly consistent? Is that consistent over 2 months? Is that consistent over, what does that mean?
12 months.
12 months.
12 months minimum.
Minimum of 12 months of 40 hours a week consistent.
Minimum.
Okay.
It's addressed differently when it's variable versus when it's not variable.
Yeah.
For example, I've got a client right now who has been working for a grocery store distributor for about 1.5 years. Up until 2 months ago, he had his first position with this grocery store. And in that position, his hours were all over the place. 30, 32, 28, 29. He just got a promotion 2 months ago. Now he's working consistently 40 hours a week and probably 10, 12 hours overtime. And so now I can rely on that 40 hours a week and use that as qualifying. And I don't need to average it because he's in a new position.
There was a qualifying change.
I have to show when he received that new position. Yeah. But then underwriting, instead of averaging his income over the 1.5 years that he's been there, they will use the 40 hours a week that he's currently working.
Cool.
Because it's a new position.
Cool. And it's things like that experienced LOs are able to do for you. And
real estate's the school of hard knocks, man.
No doubt.
You know that?
Yes.
There is no substitute for experience.
No, I've screwed up a lot.
We all have.
We all have. So that's kind of, when we're here and people are coming to, I go to Brad all the time for questions and people come to me and it's because I've screwed up so many times that I know how to get through to the other side. And
even when you know what you're doing, things change so frequently that I do this. I tend to question myself sometimes.
Yep.
And so a lot of times I'll call up my processor, I'll call up my manager and say, hey, here's what I got. Here's what I'm thinking. Does that sound right? Is there something I'm missing?
100%, 100%. Guys, thank you, Brad. Thank you for coming in. This is the mortgage world is not always the sexiest thing to talk about, but it's super important and incredibly awesome to have trusted partners to work with. We've worked with Fairway and Bradford. God, a long time.
I've been coming here 10 years, I think.
Yeah, so a long time. So if you need anything, there's going to be contact information in our show notes, in the comments. And thank you again, Brad. We appreciate it.
Thanks for having me, man.
Awesome. Y'all, take care.
Take care.